This is an overview of Chapter 7, Tax Credits. So we are going to talk about calculating child tax credit, determining earned income credit, computing child and dependent care credit, as well as the premium tax credit under the Affordable Care Act, and the AOTC, American Opportunity Tax Credit, and Lifetime Learning, which is for higher education. We will compute foreign income exclusion and tax credit, determine adoption credit, recognize other basic credits, and calculate low income retirement plan contribution credit. So remember, we did briefly discuss this in another chapter, but a credit is a direct reduction in a tax liability. So credit is a dollar for dollar. If I get a $2,000 credit, I get $2,000 against what I'm paying in taxes. If I get a $2,000 deduction, this tax savings is actually the deduction times my tax rate. A credit provides equal benefits to all taxpayers. A deduction is a reduction in taxable income, like I said, and if you get a $2,000 deduction and you're a 10% tax bracket, then you only get 10% of that, $200. If you're in the highest tax bracket, then you would get 37.6% of that, or 39.6%. If a taxpayer has a choice between a credit or deduction of equal amounts, the credit will result in greater tax savings. So let's talk about the child tax credit. The child tax credit permits taxpayers to take a credit based on the number of children they have. The Tax Cuts and Jobs Act made 3 significant temporary changes, which expire in 2025. Increase the child tax credit to $2,000 per child, increase the threshold for phase-outs, and increase the refundable amount of the credit for taxpayers whose credit is limited by their pre-credit tax liability. So more of it is refundable. The Tax Cuts and Jobs Act also offered a new qualifying dependent credit of $500 because they did eliminate the personal exemption. To qualify for a child tax credit, the child must be under the age of 17. So in the year they turn 17, they don't qualify for the $2,000. Must be a U.S. citizen or resident alien, must be claimed as a dependent on the taxpayer's return, and meet the definition of qualifying child, which we described in Chapter 1. All children must have a Social Security number at the time of filing. There are 2 parts to the credit. First, the non-refundable tax credit is limited to the amount of tax liability before taking the child tax credit. We'll go over what that means. Tax law prescribes a pecking order to prevent claiming more than one non-refundable credit. Refundable additional child tax credit is the amount of the credit that was limited by the taxpayer's liability and becomes refundable. An example. Dante has a tax liability of $2,300 before any tax credits. He's determined that he's eligible for an education credit of $400 and a child tax credit of $2,000. How much is the refundable child tax credit? Well, because he has 2 non-refundable credits exceed his tax liability, Dante would first take the education credit, and his non-refundable child tax credit would therefore be $1,900. The max child tax credit is $2,000 per child. However, these credits phase out when your AGI exceeds $400,000 for joint filers and $200,000 for all other taxpayers. Head of household, single, married, filing separate, right? The credit is phased out by $50 for each $1,000 above AGI amounts. If a taxpayer has fewer than 3 eligible children, the lower of the 2 limitations apply. The refundable additional child tax credit cannot exceed $1,600 per child, and the refundable tax credit cannot exceed 15% of earned income over $2,500. If a taxpayer has 3 or more qualifying children, the limit is $1,500 per child, and the refundable tax credit is limited by the greater of 15% of earned income or the amount of Social Security and Medicare taxes paid up to the unclaimed child tax credit amount. We'll see this in action later. A dependent who does not qualify for child tax credit may be an other dependent. To qualify as other dependent, you must be past the qualifying relative test and be a U.S. citizen, national, or resident. A Social Security number is not required to get the other dependent. The other dependent credit is not refundable. The portion of the child tax credit and dependent care credit, child tax credit and other dependent credit are reported on the 8812. That's the refundable part. Any taxpayer who erroneously claims the child tax credit due to reckless or intentional disregard for the rules loses the ability to claim that credit for 2 years. It is extended for 10 years if they determine it was a fraudulent claim of child tax credit. If the IRS rejects your child tax credit for any other reason other than a math or clerical error, the taxpayer must complete a Form 8862 in the following year after the rejection. Taxpayers must also complete an 8867 due diligence checklist. Tax preparers. This is to make sure that you're not claiming fraudulent child tax credits. Refunds due to the child tax credit will not be issued until after February 15th of the following tax year. This is allowing the IRS to review this more carefully or put in safeguards, right? Lucinda and Paul are married with 3 children, ages 12, 15, and 18. Can they claim a tax credit for all 3? So the answer is we don't know if they can, right? In general, we need to know their AGI and all kinds of other information about them. Do they have Social Security numbers? Do they meet the child? But let's just assume they're all children that meet those and they're under the threshold, right? Well, the 18-year-old is over 17, so they would be an other dependent. And the 12 and 15-year-old, if they meet everything, could qualify for that, right? So when we're talking about Earned Income Credit, or EIC, it is available to qualifying individuals who have earned income and AGI below certain levels. It's meant to assist working poor by reducing their tax burden. So EIC is refundable. Supplements your wage through a refundable credit when earnings are less than the maximum income for their filing status. It serves as negative income tax. Why? Because you get it refunded and you don't pay it. Qualifying taxpayers can receive a refundable EIC when they have no filing requirement, owe no tax, and had no tax withheld. Taxpayers must have must answer 3 questions to properly calculate EIC. Does the taxpayer qualify? Do they have a qualifying child? And what is the amount of EIC? So there is, in the appendix of the book, a table for EIC that you can look up. 7 rules that the taxpayer must meet in order to claim the EIC. They must meet the AGI limits based on the number of qualifying children. So the phase out begins with no children at 9,800 and ends. So if you earn below 9,800, you could get it. If you earn above 17,640, you get nothing. If you have no children, but in between or below this, in between phased out, below it, you would get the max. It's like a U-shaped curve, upside down U. A qualifying child, with 1 child, the phase out begins at 21,560, ends at 46,560, right? These are the limits other than joint filers, by the way. So with 2 children, it's 21,560 to 52,918, and 3 or more, it goes up to 56,838. If they are joint, here's the phase out. The range is larger. So begins at 16,370, ends at 24,200, begins at 28,120, and ends at these other numbers depending on the number of qualifying children you have for EIC purposes. So the second thing of the 7 they need is the taxpayer and qualifying children must have valid Social Security numbers. They must not eligible if they're married filing separate. So you can't get EIC if you're married filing separate. The U.S. citizen or resident alien status is required. Foreign income exclusion is not allowed for EIC. And disqualified income, certain types of investment income must be less than $11,000 or you don't get EIC. You must meet the income limits based on the number of qualifying children. That's the 7th question you must answer, right? Failure to meet any of the preceding rules will precludes a person from claiming EIC. So when you're determining does the taxpayer have a qualifying child, it's based on their eligibility rules differ based on their filing status. If a taxpayer has no qualifying children, the 7 rules on the previous slide must be met, plus 4 additional. You must be over 25 and under 65. You must not be claimed as a dependent on someone else's tax return. The taxpayer cannot be a qualifying child of someone else, and you must have lived in the United States for more than half the year. To claim EIC with a qualifying child, the 3 additional rules besides the 7 we talked about. The child must meet the qualifying child test with 2 exceptions. The child need not meet the support test, so not 50%. The child must live in the U.S. home for more than half the tax year. The child cannot be claimed by more than one taxpayer, and the taxpayer may not be the qualifying child of anybody else. We talked about this earlier in the slides, but if they reject it other than a math error, you must complete an 8862 in the future. If you erroneously claim EIC, then you lose the credit for 2 years, potentially 10 if it's fraudulent. So, what is the amount of the EIC? So if you go to the book in Appendix A, so I'm going to go to the book in Appendix B, this, it's a little blurry, is the EIC table. So you look up the income, then you find how many children, qualifying children, and then you find the credit. So if you were married filing joint, right? If you were married filing joint and you had 47,250 and 3 children as your AGI, you would get 3,406 in the credit, right? And I go up here, the max EIC is somewhere in here, 5,690, oh, a little bit more, 6,102, 6,776 is the max credit here. Let me go back up here, 7,000 something. So these are the max EIC credits, right? 7,430, that might be the max. So the max credit is 7,430 with 3 children for EIC. The EIC is reported on line 27 of the Form 1040. For taxpayers claiming a qualifying child, Schedule EIC must also be filled out. So, Child Independent Care Credit. The Child Independent Care Credit provides tax relief to working parents who must provide care for their children and certain other dependents. To be eligible, the dependent must be either under the age of 13 or a dependent or spouse who is incapable of caring for themselves. If a child's parents are divorced, the children need not be a dependent of the taxpayer claiming the credit, but must live with that parent more than the other parent. A lot of times due to divorce, you swap years of claiming the children. Qualified expenses include amounts paid to enable both taxpayers to be employed, and the amounts paid for in-home care, a nanny, and out-of-home care, daycare, overnight camps and activities providing standard education do not qualify. So you can't use private school for this, right? So for taxpayers with AGI of less than 15,000, the child independent care is 35% of qualified expenses. For taxpayers greater than 15,000, the amount decreases as income increases. The max qualified expenses when applied to the percentage is 3,000 for one dependent or 6,000 for 2 or more. A Form 2441 is used to calculate and report the credit for the child independent care expenses. Married taxpayers must file a joint return to claim the credit. The credit is limited to the lesser of the spouse's earned income. So if one spouse doesn't work, you can't claim this credit. even if you pay for childcare. But if one spouse is working and one is going to school, then it's as if they were earning. So $250 for one dependent or $500 per month, which would give you the max credit if someone is enrolled in school. Let's look at an example. Caitlin and Owen are married and filing joint. They have 3 children. They pay $18,000 in child care expenses during the year. Caitlin earns $84,000. Owen earns $40,500. What is their child tax credit? Well, their maximum. So $18,000 is their qualified expenses, but 2 or more children is $6,000. And then based on their combined income, there's no phase out, so you get 20%. So they would get a maximum credit allowed of $1,200. If they are having child and dependent care credit withheld, if they are having money withheld pre-tax from their W-2, then that would reduce the amount of this credit. Louise and Meta are divorced. They have 2 children, ages 6 and 8. Louise claims them as dependents when filing taxes. They live with Meta during the week and Louise on the weekends and several weeks in the summer. Both parents work and children go to after school, which the parents have to pay for. Which parent should pay for the aftercare and then claim the credit? Either parent would be able to claim the credit. They need to determine whose overall tax liability and see who would get greater benefit. That's assuming that they have a good divorce and they can communicate and decide what's best for everyone, right? Talking about another credit, the Affordable Care Act. This is a premium tax credit under the Affordable Care Act. Eligible taxpayers may receive a tax credit intended to lower the cost of health care. To be eligible, the taxpayer must meet the following requirements. Health insurance is purchased through the state or federal exchange, so this would be the Health Connector in Massachusetts. The taxpayer is not eligible for coverage through the employer or another government plan like Mass Health or something like that. The taxpayer does not file married filing separately except under very limited conditions, and the taxpayer cannot be claimed as a dependent of another. The specific tables required to compute the allowable credit. The premium tax credit is intended to take the form of the lesser of the following: actual healthcare premiums or a benchmark plan premium less the taxpayer's expected contribution. If you are preparing taxes for someone who receives a 1095-A, then you will need to fill out the forms for a premium tax credit. A premium tax credit can be paid in advance or when the return is filed. The advance premium tax credit and actual credit are reconciled at the end. So therefore, if you're getting an advance premium tax credit, but then you earn more money on your taxes, you'll have to return the credit you already got that reduced the cost of your health insurance. We'll do some examples in class of that. So the tax law contains a number of provisions intended to reduce the cost of education. And other provisions other than tax credits are exclusion from gross income for scholarships, employer-provided tuition assistance plans, tuition reduction for school employees, deduction of business education expenses, student loan interest deduction, qualified tuition plans, 529s, Coverdell education savings accounts, American Opportunity Tax Credit, which we're going to talk about, and the lifetime learning credit. So if you are enrolled in undergraduate and it's your first 4 years, so first 4 years of post-secondary, so after high school, for students pursuing a bachelor's or associate's degree or vocational training, the AOTC is available. To be eligible, you must meet the following: pursuing a degree or recognized credential and enrolled at least half-time for 1 semester, quarter, or trimester during the tax year. You must receive a Form 1098-T from the Higher Education Institute, not have completed your first 4 years of higher education at the start of the tax year, not have claimed more than 4 years of AOTC, and you cannot have a prior felony drug conviction. Meeting either of the following criteria precludes the AOTC: if you're married filing separate, or if you are listed as a dependent on someone else's tax returns. So if you're in college and your parents are claiming you, they would need to claim the education credit. AOTC depends on the accurate computation of qualified education expenses. It does not include room and board, non-academic fees, and expenses not related to students' courses of instruction. Qualifying expenses must be reduced by any tax-free scholarships, grants, or any other educational assistance you received, and paid during the tax year for the education during the tax year. So when you pay, if you take out loans, that counts as paying, even though you haven't paid the loan. The maximum annual AOTC is $2,500 per student. It is calculated as 100% of the first $2,000 of qualified expenses and 25% of the next $2,000. So you need a minimum of $4,000 to maximize the credit. AOTC is phased out for joint income filers between 160 and 180, and single head of household or qualifying widower 80 to 90. AOTC is 40% refundable under these conditions. If the IRS rejects the AOTC for any reason other than a math or clerical error, you must complete an 8862 in order to claim it in the future. If you erroneously claim AOTC recklessly, then you lose the ability to claim it for 2 years or 10 years if they determine it was fraudulent. Unlike the child tax credit and earned income credit, there is no time restriction on the issuance of refunds, so you can file this when taxes come out. Taxpayers must prepare and file an 8867 due diligence. And the failure to file a due diligence form results in a $600 penalty to the tax preparer. Which of the following precludes a taxpayer from claiming AOTC? The answer is married filing separate precludes you. So if you don't qualify for the AOTC, which is a $2,500 tax credit, of which some of it was refundable, then you might qualify for the lifetime learning. This is not refundable. The purpose of the lifetime learning is to encourage taxpayers to enroll in eligible institutions to improve job skills or acquire job skills. The maximum is $2,000, which is 20% of $10,000 in fees. This could go to graduate school. So if you've already finished taking AOTC and you're going to graduate school, you could get the lifetime learning credit. It's available for qualified expenses for the taxpayer, spouse, and dependents. It's available for undergraduate, graduate, or professional courses at eligible educational institutions. It's non-refundable, unlike AOTC. Has no course load requirement, so you don't have to be enrolled at least full-time, half-time. You could just be taking one class, and is not subject to felony drug offense restrictions. The lifetime learning credit is phased out for married filing joint 160 to 180 and everyone else 80 to 90. You cannot use both credits on the same student for the same year and same expenses, but you could take an AOTC for one student and the taxpayer themselves went to graduate school and take it. So you can take them, and they're all filed on Form 8863, which we will do in class. So David and Vivian's tax status is married filing joint. They have 2 dependent children and AGI of 72,000, so they're not in the phase out. Their son Steve is taking 4 credits part-time at Baton Rouge Community College. His tuition is $4,200. Their daughter Cora is a freshman at Tulane, and her tuition and fees are $39,200. Neither child has a felony drug conviction. What amounts can David and Vivian claim, assuming no scholarships? Here we go. I don't know who Sean is, by the way. I think that they mean, who's Sean? Is it Steve? Steve. I think that's Steve. Steve may not take AOTC because he's not enrolled at least half-time. However, he does qualify for lifetime learning, so $4,200 times 20%. Corey is a freshman and qualifies for AOTC, which is at $2,000 times 100%, and then $2,000 times 25%, so $2,500. Thus, they get education credits. We add the two together and get $3,340. They get the full amount of credits because their AGI is below the phase out. During the year, Jason, a single father with AGI of 85,000, paid $2,500 for his master's degree in fine arts with the hope of becoming a writer. What lifetime learning credit is he eligible for? Without any limitations, he would be eligible for the maximum lifetime learning credit of $500, 20% times the tuition. However, due to his income, he phases out between 80 and 90, right? So we take the 500 times the high end of the maximum of the credit minus his actual AGI divided by 10,000. So his credit is $250, not $500, because he's phased out. So other tax credits that we're going to discuss, the foreign exclusion and tax credit. So foreign income exclusion allows certain taxpayers working and living outside the U.S. to exclude a certain portion of their foreign income as well as foreign housing from the taxable. The limit is $120,000, and this is claimed on Form 2555. Foreign tax credit, expats and investors whose income are subject to foreign taxes may use the tax credit to reduce their tax liability. The amount of the credit to the U.S. tax applies to the income. Net foreign income divided by foreign taxable times U.S. tax liability. The foreign tax credit is typically claimed on Form 1116 unless the taxpayer meets all of the following requirements. All foreign source gross income was passive income. All income and any foreign taxes paid on dividends were reported on a qualified payee statement, div, interest, or K1. And the total credit for the foreign taxes aren't more than 300 or 600 filing joint. If all requirements are met, the foreign tax credit is entered on Schedule 3, Form 1040. Foreign tax credit is non-refundable. Any unused credit can be carried back 1 year or forward 10. Joseph Steele had $200,000 in income from the United States and $100,000 from employment in Lithuania. He paid $40,000 in Lithuanian taxes. Assume his tax liability, U.S. tax liability, is $85,000. What is his foreign tax credit for the year? Foreign income divided by total taxable times U.S. tax liability means he gets a credit of $28,356. The unused credit of $11,644 is $40,000 foreign taxes less the $28,356, and it may be carried back or carried forward. So there is an adoption credit. This is for individuals who are allowed an income tax credit for qualified adoption expenses. The adoption credit is reported on Form 8839. The total credit can be taken for years with respects to adoption of a child is $15,950. This credit is adjusted, is the total amount for each adoption, not an annual amount. The amount of the credit is reduced if your AGI is over $239,230 and phased out completely at $279,230. The adoption credit is non-refundable. Any unused portion can be carried forward 5 years. Individuals must file jointly, and the taxpayer must include name, age, and TIN of the child on their tax return. There is domestic multi-year adoption. So if a child is a U.S. citizen at the time of adoption is commenced, the credit for the qualifying expenses are allowed in the tax year that follows that year that the expenses are paid. If the expenses are paid or incurred in a tax year and the adoption becomes final, the credit is allowed in that year. The full $15,950 is allowed in adoptions of special needs children, regardless of how much you paid. So sometimes you might not pay anything, and you still get the full credit. For multi-year adoptions for foreign children, if the child is not a U.S. or citizen or resident at the time of the adoption, the credit for the qualified expenses is not available unless the adoption becomes final. The credit for qualified adoption expenses paid in the tax year the adoption becomes final or any year earlier is allowed in the final year. If your employer provides adoption assistance, the employees may exclude W-2 earnings on any qualified adoption assistance expense paid by the employer. The max excludable is the credit, $15,950, subject to phase out. Taxpayers may claim both a credit and exclusion for adoption, but not the same expenses for the credit as the exclusion. There are many types of credits directed at individuals, businesses, and in general, and different types of specific business credits or those involving energy. There's elderly or disabled, there's mortgage interest, first-time home buyers, research and experimentation, work credits, rehab, low-income housing, new markets. One thing that's popular that you will see is energy credits. There are a number of personal tax credits for energy credits, which have been expiring. By design, they were temporary to create short-term changes in taxpayer behavior. Clean vehicle credit is extended through 2032, Energy efficient home improvements 2031, residential clean energy credit 2034, and qualified fuel cell motor vehicle credit 2021. So that has expired. The clean vehicle credit has two parts, $37.50 for critical materials in the battery are domestically sourced, and $37.50 if the battery components are domestically produced. It is not available for taxpayers with AGI over certain limits or for vehicles where the manufacturer's suggested retail price is above a certain minimum. The used clean energy vehicle credit of 30% of the price up to $4,000 has been added for 22 and before 2033. There are no limits on sale price or AGI. It cannot be claimed more than once every 3 years. Energy efficient improvements are 30% of those paid for qualified energy improvements or 100% of qualified residential energy property expenditures. It is limited based on the property type that is installed. So solar, think about solar. That's what we're doing. Or potentially windows or something like that. The taxpayer may claim 30% of the amount qualified for solar, electric, solar water heating, fuel cell, small wind energy, or geothermal heat pumps through 2032. The credit applies to battery storage technology beginning in 2023. Certain taxpayers may claim a non-refundable, so that's the end of energy credits, by the way. Certain taxpayers may claim a non-refundable low-income retirement plan contribution. It's 50%, 20%, or 10% depending on filing status and gross income. The credit is a direct deduction from income taxes otherwise payable and is a savings. Taxpayers receive 50% of the credit for contributions up to $2,000 or for married filing joint, or a max of $1,000 credit. The credit phases out with AGI over certain limits and is part of Form 8880. We're not doing this case study, and that is it for the overview on Chapter 7. We'll do a lot with credits after this.